to today's MNI Webcast with Tom Barkin. Tom is president of the Richmond Fed and a voting member of the FOMC this year. And before leading the Richmond Fed, he had a long career in consulting, so it'll be great to get his insights on a fast-changing economy with lots of potential structural issues as we emerge from the COVID recovery, the COVID recession rather. He had a long consulting career at McKinsey, where he spent 30 years as a senior partner and eventually chief financial officer. And he also served at the Atlanta Fed's board between 2009 and 2014. So thank you so much for joining us, Tom.
Great to be here.
So before we get started, I just wanted to urge our viewers to keep the session as interactive as possible by submitting your questions in real time. We urged everybody to submit questions ahead of time, but it's always easier to follow up than it is to preempt. So just keep them coming in. We'll monitor the chat. The session's fully on the record, and we'll go for about an hour with a little potential for overtime, because Tom's been very generous with his time, so we appreciate it. Thank you so much. I just wanted to get started by just asking for a brief overview of how you're viewing the economy as we enter a pretty hot summer. We had a period of a lot of upside surprises, especially on the growth and inflation side. And I'm wondering whether you think that momentum has already peaked or whether we're still on our way up.
Well, it's almost second derivative math, but I mean, I think the second quarter is going to look on a historic basis like a quarter we're going to look at for decades. GDP growth is going to be monumental. You've already seen inflation prints that show inflation is going to be quite significant. And so I do think those will be the peak quarters for both GDP and inflation. That doesn't mean that the GDP is not going to continue to grow. I mean, obviously, we've got significant amount of excess savings in people's pockets. You've got what's going to be a great summer ahead of us. And so we're going to continue to see growth in GDP. I just don't think you're going to see quarter over quarter growth in the way that we saw the first quarter versus the second quarter, what I expect to see in the first quarter versus the second quarter this year. And of course, that all makes sense. You've reopened an economy after a year off with a lot of pent-up demand.
Yeah. And do you think, I want to actually, before we get to the upside risks and inflation risks, which have been dominating the headlines, I kind of wanted to ask you about the remaining lingering downside risks, especially as we watch. It's easy to get, become insular in our news cycle. If you only consume U.S. news, everything seems hunky-dory. But if you watch international news, the COVID crisis is not over. I just wonder how you're looking at the Delta variant, what kind of stuff how you're looking at that, and what potential downside risks of a resurgence that is potentially vaccine resistance. What's your level of concern about that?
Well, I think your instincts are right. In the circles I travel in, it's almost as if this thing has been declared over. People are hugging, holding hands. All of the stuff that we didn't do for a year has come back in force. And there's an invincibility feeling, I think, among people like me who've been vaccinated and see the results in the US, which have been extraordinary. I was looking at some numbers in the UK yesterday, though, which would suggest that the UK, which has closed down or at least extended its quarantine periods for the end of the month, in the context of the Delta variant, its vaccination rate, 2 doses, 1 dose, are actually ahead of now the US vaccination rate. So that case rate has expanded despite a vaccination rate which has been stronger than the US's. And so that does give you pause. Let's say on the positive side, it does look like there's been no increase in the death rate. And so the vaccine, which never was, suggested it wouldn't stop infections, it's just stopped the most severe of the consequences, at least appears to be working in the UK. I think that's the thing I'm watching closely, because, if you follow the 1918 pandemic, it did actually, drop during the summers and then come back, albeit, weaker the next spring and the next fall. And so you have to be aware that there is that risk there.
Yeah. So okay. So now switching to a little bit of the other side. So you've been fairly sanguine on the inflation front in terms of your view that what we are seeing now will be fairly transitory. I know we had some upside surprises in terms of the numbers, 5% prints on CPI, get people's attention. I wonder how long you see that persisting and what factors you're looking at to see. There's been this dynamic about, service sector versus industrial sector price pressures and how they're fluctuating. How are you trying to assess whether this is transitory or not?
Well, I do think that there was a period of time at the beginning of the year where there was a lot of producer price inflation, but it hadn't yet hit the consumer prices. And then there's been this period where the drumbeat about inflation has gotten such that businesses I talk to everywhere have been comfortable. I'll call it capitulating and raising prices. And that's, I think, been broad-based. You can't help but notice what a big part of the net price increase we've had has been driven by places where you've had supply chain issues like used cars, or places where you have return to normal like airlines and hotels, and places where, frankly, you have both of them like rental cars, which for a couple months has been the number one highest price increase category just because you can't get them. And everyone wants them. And so there's absolutely an amount of temporariness in that. And so I do expect to see prices in a lot of those categories actually revert, as you've seen lumber in the last few weeks and other commodities as well. And so I think things will come back. The question, of course, and the thing I'm probing with my business contacts is, well, what does this mean for next year? What does this mean for the conditions for pricing for next year? And I would just start by saying it is actually a fact that businesses don't like increasing prices. And that may seem counterintuitive because it's the easiest way to grow margins analytically. But you have to convince your salespeople to take a risk. You have to deal with your customers not being very happy. And so I think there's a very strong reversion to historic behavior mindset there. And of course, just because that tendency is there doesn't mean the reversion is going to happen. And so what the environment looks like will matter a lot. Do they feel still another broad set of cost increases? That would change their mindset. Potentially unfunded stimulus programs could change that mindset. Potentially issues with international relations, you can imagine a regime where we have a even greater set of issues with China could change that mindset. But at least as I'm testing it right now, I think people haven't, decided we're in a different regime. I think people intuit that this is temporary. We're going to go back to something like the old regime, maybe with a little higher inflation expectations. But again, that's something you can't it's not a static assessment. You have to keep watching that, because over time, if enough things happen, that regime could change.
Yeah, I know you made a really interesting point yesterday at your talk at the Atlanta Rotary Club about that, your business contacts, and how their biggest thing was the capitulation factor, right? It was not how quickly can we get to this, and that to me seems like a kind of a disinflationary, drag. The fact that people are reluctant, that this is a kind of last resort measure rather than a first mover kind of thing.
Well, just remember, and I've said this, there are very serious headwinds that have kept pricing down over the last 20 or 30 years, particularly for goods. And I would start with the power of the big box retailers. You do not want to go into a Walmart or a Home Depot with a price increase, because they're going to compete you in other places. They have a purchasing department that is bound and determined not to take price increases. I've talked to a friend of mine who's a furniture retailer, and he doesn't want to increase prices because his customers shop first online. And he thinks if he increases prices, they'll find somebody with a lower price. And so the technology and how it's enabled price transparency is another thing that's limited prices. And of course, globalization would be a third. And so all these things are out there. They could obviously change, but they're all out there. And so, and I'd say there's been 25, 30 years of relative price stability.
Yeah.
And so as businesses weigh this, they weigh the absolute, price and inflation pressures of the last few months against what they've learned in their business careers. And the question is, at what point you pivot to a different mindset. But again, as I've been probing people, I don't quite see it yet. I think, again, you just got to watch that you don't get, embedded in a static view of this.
Yeah. And then is there any concern that inflation expectations that there's a self-fulfilling prophecy aspect to the high inflation prints, that the high inflation prints kind of change people's mindset, and if they linger for long enough, then inflation expectations will get to a level that becomes worrisome rather than welcome?
Certainly, the more you experience high inflation, just like the more you experience low inflation, the more your mindset evolves. I assume and hope they're looking at how the Fed and other central banks around the world are responding or are saying they're going to respond. Certainly I'm watching market measures of inflation compensation, and it is interesting. All of these, there was an increase in inflation compensation in the first couple months of the year, but when all these prints came out that were higher than most analysts forecast, inflation compensation really didn't move at all. I just thought that was interesting to watch. And so, you always, in my job, worry about the unanchoring of expectations. But again, I'm trying to be open-minded on the question, but it's hard to see it now, either in the market metrics or my business contacts.
Okay. So we have a question from the audience here in the chat. Let's see, which is, does the Fed have a unified definition of transitory? I don't know that it has, but I'd love to get your views on what transitory means, as far as, if I could elaborate on the question a little bit, kind of the length of time, the length of time over which you're willing to tolerate over target inflation, and also sort of the level at which you become worried.
Well, I can guarantee you there's not a unified definition, because I try not to use the word. I mean, I actually don't like the word. I use temporary, just because I'm ornery probably. But so here's how I think about it. I can't speak for others. If I look at something and it looks temporary and explainable, that's different than looking at something that seems like it might be a augur of a broader trend. And so when I look at rental car, when I tried to get a rental car in Tampa 2 months ago and it was $380, I didn't say, holy cow, rental cars next year will be $700. I said, okay, this is a temporary thing, which I can explain, right? New car outages, car companies sold off their fleets, et cetera, et cetera, et cetera. So to me, the reversion factor really matters. If I think something's going to revert, as I do believe, car prices, rental cars, that's very different than something I think that won't. By the way, I try to be fair-minded on it, which is, if I'm going to look through transitory, temporary factors this year in terms of, return to normal pricing on airlines, then I probably ought to look through temporary negatives next year too. If used car prices come back down, I should try to adjust for that. And so I am thinking about this reversion thing, on both sides. The things that appear to be the least temporary in nature are things like rents. So that's something, I'm going to look very hard at. I am looking hard as I am starting to see the signals that goods demand, while still elevated, is nowhere near as elevated as it was when services weren't available. And so as goods demand starts to slow to elevated, but not, as elevated as they were kind of levels, what's going to happen to that pricing? Because goods pricing has been, as you know, basically deflationary for 20 plus years. So that's another, thing, is something really changed in how we think about those. So those are the kinds of things you look at. But to me, there's not a date issue. It's more the nature of the item. And again, it's helpful to look at broader metrics. It's helpful to look at the trim mean, which still appears, I haven't looked at it since Friday, but it's just under 2. It's helpful to look at what core PCE has done since before the pandemic. It's still in the low 2s. And so you just have to try to look at the horizon as opposed to look at today and see, where you think this stuff's headed.
Yeah. And on the employment side, speaking of horizon, the progress has been a little bit slower than we kind of, earlier in the year, we got this amazing March print. It looks like 1 million jobs, and it looked like maybe we could sustain that for a while. There's a lot of optimism, and then we seem to have moderated that optimism a little bit. I just wonder, what level of payrolls monthly growth do you think is kind of a healthy level? And what other kind of below the surface indicators within the employment area are you looking at for, both for substantial progress and just generally for, as for the goal of full employment?
Right. So, I mean, the numbers, 7.6 million fewer people employed. I've heard people say, and don't forget the 200,000 a month we were adding before the recession. So that gets you to, I don't know, 10 million or something. That's a lot of people. And I think the question for me is, how much of that can come back? I am one of those people who believe there are temporary factors that are holding us back. I really don't believe we're done at this point. And you could point to those. It's just like the conversation we had about temporary factors on inflation. I mean, do I believe that enhanced unemployment insurance plays a role? I do. Do I believe that concerns about childcare and schools and parental care or kid care, still matters? I do. Do I think there's still people who are worried about the virus and don't want to go back to work? I do. Do I think there are people who've got enhanced savings and have the time to be choosy in a world where it's entirely possible that people's wage aspirations have increased because of the whole conversation about the $15 minimum wage, then supplemented by people like Walmart and Chipotle and others announcing higher wages? I do. So I think and believe all this stuff's going to sort. What I don't know yet is, what does it sort to? Does it sort to 7.6 million or 10 million more jobs, or does it sort to something under that? And in that environment, you look at the surge in retirements. This year was 3 times more than the prior year. Historically, most of those retirees don't come back to the workforce. You talk to people, and I certainly do, who have rethought their lives. And do I, wonder whether some number of people are not going to go back to the workforce, or going to go back at a different intensity? I do, but I still think we've got a long way to go on the job front. Even if we don't get to 7.6 or 10 million, I think there's a lot more to get. So, to that end, I'm hoping, expecting, you'll see prints like the print we had last month over the next several months. And I really do think, expect, and hope that when we get to August and September, we're going to see really good numbers. And I think those numbers, to me, will be an indicator that the job market has unclogged, reopened, and we'll be able to get closer to what our potential is.
And you focused a lot of in the employment to population ratio, because that's, of course, that is employment. Other than, let's looking at the glass sort of half full rather than half empty, right?
Yeah.
But that number is edging up fairly gradually. But I guess the expectation is that you still have these bottlenecks that may clear up by the end of summer, say, and then we could kind of get a burst.
Right. It was
entrance.
Employment to population was 61.1 back in February of 2020. In December, when we did our substantial further progress metric, it was I think just over 57. Today, I think it's in the low 58s. And again, you could build a case that this economy's not going to get over 59 or something. I just don't believe it. I mean, I think I can point to very real reasons why people are out of the workforce. I can look at a bunch of people who need workers, who are, by the way, paying them more than they used to pay them. And I don't see anything that, well, I can talk about structural factors. I don't see anything that fundamentally structural that means that we've dropped 3 points in potential, over a 15-month period. That just feels far sharper than what reality is. So I may be proven wrong. If we get to October and November and you don't have the kind of recovery that I think we're going to have, that would be news to me and make me rethink, where I think the economy can get. But right now, I still think the economy can get significantly further along than it is right now on the labor side.
So against the backdrop of that picture, and given that Chairman Powell has officially opened the discussion on tapering by saying that you guys are talking about it. Do you have any particular views on the direction and or timing that it should take? Do you know, is it all conditional on this progress on employment that you have outlined? And
Well,
what's your current outlook for that?
well, we are outcome based. And so, I like the way we've defined that also on the rate side. And for me, substantial further progress has an inflation piece and an employment piece. On the inflation side, I think you can argue reasonably compellingly, we've made substantial further progress on the inflation, whether that's on the prints that we were talking about earlier or on the firming of inflation expectations, however you think about it. On the employment piece, I'd still make the case that as of the last employment report, and of course we'll get one Friday, that moving from 57 to 58 when we were at 61, 15 months ago, doesn't yet feels like further progress, but it doesn't yet feel like to me like substantial further progress, and that's the metric I'm watching. And if we can get substantial further progress on employment to population, then combined with that, I'd be ready to start tapering. I do think it's important as we think about tapering, and I'm not being cute, but when you decide you want to talking about tapering, then the next step is to talk about tapering. And so I'm looking very much forward to talking about tapering, and I have an open mind as we enter that conversation, because there's a lot I'll learn from my colleagues in that area. But I'm a big believer in optionality. As we were talking about at the very beginning, the economy could evolve much hotter than I forecast, or you could have a variant and it could evolve much less hot than I would forecast. Those things are very much in the range. And so I have the sense the markets would like us to be extremely specific about dates and sizes and timing and whatever. But I personally believe optionality is well worth buying in this kind of situation.
Do you have a view at this point on the the particular issue of mortgages that has arisen about whether MBS might be a good candidate for the start of a taper?
I'm open-minded on it. I thought the Journal had a good article this morning that laid out, the two sides of that debate, and I find both sides appealing. I think we've not described this. This is different than 10 years ago. We've not described this as an effort to support the housing market, but more as an effort to provide liquidity into the financial markets. And so, making a case that you want to try to differentiate the kind of liquidity feels complicated. On the other hand, I recognize and appreciate the arguments of folks who say the housing market is pretty hot right now. Why exactly are we giving more support to the housing market? So I think both of those are legitimate, and I'm open-minded to it. I think whatever we do also has a third criteria, which is just, I'll call it simplicity. Is it easy to communicate? Do people understand it? I think there is some downside to trying to get too clever in how you move left and how you move right. And to the extent that we're going to, at some point here, reach substantial further progress and start the process of tapering, I would also, in addition to the arguments that I just discussed, I also have some preference for sort of the least drama way of moving back to normal.
Yeah. So we got another question from the audience, which is that the guidance on taper is clear on substantial progress, just as you've laid it out, but they were asking about what kind of time lag would be ideal before the start of rate hikes. And there's an assumption built in there that there would be a lag, and there's discussion in the markets about whether or not those two might overlap. Is that too far into the future for your optionality, or
it's pretty far in the future, but I'll just say, and I've said this in other places, I mean, obviously if you've got the ability to design a perfect world, you wouldn't raise rates and taper at the same time. You would have a sequencing there, because while you're tapering, you're still buying assets, and therefore you're lowering yields. And so lowering yields and raising rates at the same time is sort of a mixed message. So if I had my druthers, I would, have some sequence there. The world doesn't always evolve like you plan it, but that would certainly be my druther. And then I think you can just go back to optionality on the timing. I do want to be ready to raise rates when the conditions on raising rates in our outcome-based guidance are met. So I don't want to and I think those are relatively in line with our new framework. I think those are more accommodative than our past. I'll put it that way. In terms of guidance, I don't want to put more constraints on that look like, and in addition, we have to wait until A, B, C, D, and E, which is why for me on the tapering, I just want to make sure I think about us having a flexible model, something that gives us optionality. So were those circumstances to be met, we could do what we've, committed to do. On the other hand, I don't see any particular reason to rush through it if we don't think we're going to get there. So this is why I'm built to be interested in optionality. And I don't really think it's a good idea to put additional criteria on the date of raising rates.
Yeah, no, that makes a lot of sense. I wonder, there's a question about fiscal policy generally, and I'm wondering, I had wondered ahead of this interview how much, I think the market's mindset shifted a lot between before and after the election because of, the shift in political appetite for fiscal stimulus. There was the notion that monetary policy was out there on its own, and suddenly you had a new impetus, and that was that combination that was potentially inflationary and generated these fears. How much has fiscal policy changed your outlook for inflation, kind of long run inflation? Do you see it as a kind of, something that's going to continually stoke inflation, or some of your colleagues have talked about it potentially creating a fiscal cliff that, just like the transitory inflation factors you've mentioned, it might actually be, a future drag that you have to consider in the other way. So.
Yeah. So first of all, we ought to give fiscal a lot of credit. The CARES Act, the stuff that came in March, April, May of last year was really fundamental, I think, to keeping the economy, somewhere close to the rails during a time of unprecedented uncertainty and unprecedented trauma. And so, I don't think you can talk about all fiscal with the same brush. I think that was really quite extraordinary and different than what we've seen in prior recessions. There was a sizable package passed in December. There's another sizable package passed in March. I think you can see quite clearly in both of those packages the impact on consumer spending. I watched the credit card dailies, and you can actually see it the day it hits people's checking accounts. And so there's no question in my mind that consumer spending, both in January and in March and subsequently, has been supported by these payments. I think, I do believe there's some amount of the clog in the labor market that's been created by some of the unemployment as well. And so, it has the effect it affects. I've never felt, though, that monetary policy was on its own there. I feel like fiscal has been a very real partner in this episode. I don't have a crystal ball to know what's going to happen from here, but I think certainly it looks like there will be additional fiscal, at least has been proposed, and at least seems to have more momentum than it did before. In my mind, the question is what gets paid for and what doesn't. I think fiscal that gets paid for, that's a worthwhile investment of resources, doesn't feel to me like that's inflationary. It feels to me and doesn't feel like it's necessarily stimulative. It feels to me like it's good investments that are made. The infrastructure bill, for example, that's just been agreed to is over, I think, an 8 or 10 year time period. So I don't think that's a big inflation driver or GDP driver. So that it should be evaluated on whether it's a good investment. Fiscal that's not paid for, I think, could add more stimulus to the equation, could add more inflationary pressure to the equation. And so I'm a little more cautious about stuff that's not paid for. By the way, it doesn't sound like people are talking about doing stuff that's not paid for. So I'm not suggesting that's where folks are headed, but I am nervous about it. Could there be a cliff on the other side? Sure. Fiscal has been a big part of supporting the economy. You can certainly look at disposable income, and you can see that in spades. I will say, though, there's still 2.6-ish trillion of excess savings in people's pockets. That I also see that as a powerful enabler of GDP over time. So I think there will be some reversion, certainly on the fiscal side of the GDP accounts, but I'm hopeful that what we're seeing on the consumer side is going to continue. And of course, that then, will enable a lot of what we're seeing on the business investment side to continue as well.
You might imagine, I hate to keep jumping back and forth, but there are a lot of questions about QE on the chat. So I'll keep going back to these. One is I actually wanted to channel the ever wise Julia Coronado, who tweeted about what we should ask regional Fed officials recently. And it's mainly about how you see QE affecting the economies. We talk about tapering, and there's been a lot less discussion about the exact transmission channel, if you will, of QE this time than there was in the last crisis, in my observation. I just wonder how much, her question was essentially, how much do you see the withdrawal of quantitative easing affecting interest rates, and how much tightening are you executing by tapering? And in the same vein, the question that came in through the chat was basically about your fears of a taper tantrum and how you intend to manage those. You talked about optionality. It seems like, while it's nice to keep your options open, the times where markets run into trouble and is when there's a wide gap between expectations and what the Fed delivers. So,
well, if I can steal from Jeremy Stein, who I think said it about monetary policy more broadly, not about asset purchase specifically, but this notion of getting into the cracks, I think is one that has been a warm thought to me. So obviously, we got into this round of asset purchases not to support the housing market, but to support poorly functioning financial markets. And for several months, this was all about spreads and getting bid-ask spreads back to normal levels. And then we transitioned to supporting the economy more broadly. And I think it is much more around liquidity getting into the cracks of the economy than it is any specific movement on rates. I've seen different studies which show different rate effects. I'm probably not of the view that we're having a massive effect on short, medium, or long-term rates through these purchases, and therefore I'm less concerned that the withdrawal of the support is going to somehow lead to a spike in rates. But there's a lot of academic studies that would take both sides of that. Sorry, I'm spaced on your second question.
Taper tantrum.
Oh,
right?
well, I mean,
are you worried about it, and how do you, and also within, one of my questions actually is about, you talked about optionality, but is it the case that you see the taper as a kind of, once it's in motion, you should leave it be because it's kind of its own thing, or is there a chance that you kind of might pause the taper if conditions shift drastically?
So how would I put it? A swift and highly visible financial market conniption, it doesn't feel like something that is good for financial conditions, and so I'm not interested in that. That's not the plan. And certainly the chairman's been pretty clear on his the way he wants to communicate, and certainly he had the experience of the taper tantrum in a way that I didn't. But I guess I don't see optionality as being market negative. I think we have outcome-based guidance. That outcome-based guidance has optionality embedded in it. It says if the economy comes back stronger, we'll do things faster. If the economy comes back weaker, we'll do things slower. And my hope and expectation is that sophisticated actors like the ones in the markets will be able to evolve in that way, rather than there being some cliff effect where you wait for the chairman to pronounce something. And so my hope is that optionality is actually going to be more sensible to markets, not less sensible to markets. You'll get that kind of reaction. That'd be my hope.
Okay. What do you make of, speaking of market reaction, what do you make of how the market reacted to the dots? And is there an overemphasis on these little dots?
Well, I mean, I'm a big fan of the SEP process in one way, and a big opponent of it in another way. And so I feel like this. I think it's the greatest exercise in the world that every 3 months I force myself to sit down with the folks on my team who are great modelers, and to ask the questions of whether my views on policy are fully grounded with my views of the forecast, and to push myself on that question and evolve my thinking in a grounded model-based way. So I think, first of all, that's a great discipline and exercise. And I'm really, maybe, when I started, this process was already underway. And so hopefully, even if it hadn't been underway, I would be doing that. But I find that to be among the more stimulating parts of my job, to sit and really force myself to ground my instincts with my forecast. Second thing I'd say is, I think it's unbelievably valuable to see the similar exercises done by my colleagues, and to ask myself the questions, if I'm an outlier on, one side of the house or another side of the house. By the way, that could be on the dots, but that could equally be on, what's the neutral Fed funds rate, or what do you think maximum employment is? And, what do you think is going to be 2022 inflation? And then push myself with my team in terms of, okay, what do I learn from that? Am I proud to be an outlier, or are they thinking about things better than I am? That's a second worthy exercise. What I don't think is that helpful is to force the chair to go out every 3 months and defend a bunch of dots that we didn't even discuss in the meeting and we didn't collaborate and vote on. So I think that's sort of, it's like asking me to go swimming with some weights on. I just think it's all that helpful. And so that's where we are, but I feel bad for him every time he has to do that.
Yeah, it does look, squeamish in a way. And it's, and he specifically said, to your point, we never discussed the timing of liftoff, right? This is,
right.
And yet we in the press are left with the best information we have. The best headline that we can write, given the information, is that X number of officials expect a rate hike in that given year. And that's the information the market seeks. So it really is a communications predicament.
I think what I would have taken out of the last SEP is that the outcome-based guidance that we've given is still the same outcome-based guidance, that over the 3-month period between forecasts, a number of participants saw inflation coming back stronger than it otherwise did. I don't know why that would surprise you, given what we've seen in the second quarter. And based on stronger inflation and somewhat more in out years, some number of them, move forward their dots. I don't think that's a particularly, not only I don't think is that a crazy outcome, I think the financial markets were already there. If you look at the Fed funds futures market. So it's interesting that there was much reaction, but I see outcome-based guidance being the same, forecast changing for some of the participants, not all.
Got it. Now let me channel somebody else. Let me channel the market bears on Twitter and elsewhere who are continuously griping at the Fed for basically for creating what they see as a one-sided market that never falls. In other words, they see the Fed is kind of rescuing and artificially propping up asset prices. How do you respond to that concern, and how do you view financial stability risks as far as the kind of financial market activity we're seeing, ranging from crypto to SPACs to NFTs and other sort of bubbly sounding things that, those of us who were around in 2000, 2001, it rings a bell.
Yeah. So first thing is, I'm focused on unemployment and inflation. I'm not focused on asset markets. And so I think anyone who's trying to interpret, certainly my view of what the Fed's doing, should be focused on the mandated goals, not on the markets. First point. And I think it is extremely hard, even though I have some sort of instinctive affinity to it, to sort of say what we ought to do is prick a bubble or something, because then you get in the situation of, well, if that's not the right answer for inflation and unemployment, why would you do the wrong answer for inflation and unemployment in the pursuit of doing something else to markets? It's just a very hard formula to try to land. I think the key financial stability thing, which we learned in 2008, is leverage.
Yeah.
And I think that is really the thing that we have to watch. And I really like this quarterly financial stability report that we do. And I think we release it publicly biannually. And it really does get into, questions of valuations, questions of leverage, questions of mismatch and the like, maturity mismatch and the like. And so the thing I really watch is leverage. I say that knowing that I can't see it all, right? But you can see leverage in the banks, and you can see that the banks are significantly less levered than they were, the last time. You can see leverage in the housing market, and you see the housing market is significantly less leveraged than it was in 2008. You can see that, the US government is more levered. You can see that the corporate debt markets are more levered. And so those are places you want to focus. And then there's this hidden leverage that's out there, that's hard for us to track, but I think is well worth trying to track. Where you see, I think it was February of 2018 when the first tariff announcement came in. There was a volatility fund that lost 85% of its value. Well, nobody invested in the volatility fund thinking they had a chance of losing 85% of their value. It was just leverage. Archegos would another place. It's just excess leverage that is hidden that you don't see about. I think that's really the financial stability risk. And certainly within our charter, I'd like to see as much monitoring of that as we can. And frankly, if we can't do it and others can do it, great. But somebody ought to be on top of this issue of leverage and compounding leverage. That's the thing I worry about.
Yeah, I really dislike the term. I've come to really dislike the term shadow banking system. I mean, it made sense when it first arose, but these are very marquee names in finance these days. Like, they're not in the shadows really. So there's no reason for, for them to be as opaque necessarily as they are, to your point. What about the issue of inequality and the notion that the Fed is just, by boosting asset prices, you're benefiting the rich at the expense of those who do not hold similar assets?
It's an interesting debate, and I've read a bunch of stuff, including the New York Fed wrote an interesting article in the last couple months. Here's how I've settled it. I mean, our mandate's unemployment and inflation, and if in pursuit of that goal, we bring more people in off the sidelines, that's good against our mandate. It's also good for those people. The research would show if you get into the labor market, you're more likely to stick. And if you stay out of the labor market, you're more likely to have scarring and be out. So I think there's a long-term good to be able to bring people in the labor market if it makes sense, under our dual mandate. On the asset size, low rates to improve employment may well increase asset values, and assets are clearly disproportionately held by, those with money as opposed to those without money. But if we're going to normalize in time, which I think we should and will, then, those values will come back to normal levels. So you've got a long-term boost in the employability of people on the margins, and a short-term boost that will revert in asset prices. And that sounds like a trade that's not an inequality trade. That actually sounds like an equality trade.
All right. Thank you. So also sticking to the financial stability theme, we talked about the MBS in the QE context. I just wonder if you're worried about the proportion of new housing stock that's going to kind of institutional investors. And I heard you talk about the affordability question yesterday, and how do you get around the fact that, large asset managers are buying up properties, which then reduces the quantity of available, affordable space, and how do you break that cycle?
Well, we clearly have a housing market challenge. I think it's been built on, at first, just the trauma of 2008, which led, developers to be more reticent to develop and banks to be more reticent to lend, and homeowners to be, or potential homeowners to be more reticent to buy. And so if you look at the volumes of, home production, home sales in the 2000s and compare it to the 2010s, you can see that impact. What's happened now is, I like to say there's no way to understand the faults of your home better than to be in it 24 hours a day. And so you got a set of people who've lived in their home and want to move to another house. You've got millennials who are finally having kids and thinking they want to buy houses. You've got big city multifamily residents who may have decided now's the time to move to the suburbs. You've got people thinking a second house would be great to buy. So the demand, and you've got low rates. And so demand is just skyrocketed at a time where the inventories was already low because we hadn't had much development. And, because you wouldn't want to sell your house before you buy one. and because a bunch of retirees maybe aren't moving out of their house to nursing homes or multifamily situations because of COVID, the supply's been constrained. And so that's the housing market. And of course, the answer to that is, I don't think the demand's going to go away. So the answer to that's build more supply, but it takes a while to build the supply. It's hard to find home builders, plumbers, welders, construction people. By the way, it'll be even tougher if we have a big infrastructure package and we don't do something to expand the infrastructure workforce. And construction materials have escalated. And so it's gotten costly. And all of that is a normal market set of functioning things that'll take some time to work out. But, on the other end of that is a more balanced market. The issue is in the interim, it's got real issues on the affordable housing side. And affordable housing, in the end, has something to do with money. Because if the market produced enough affordable housing, we wouldn't have an affordable housing problem. And so there is a whole layered and complicated set of subsidies that are done by the federal government, by certain states and localities. And I do think it's prime time to look at that, because I think you're going to have a very strong housing market for some time, and that will have second order consequences on the affordable side.
And I would think that creating affordable housing, especially for affordable housing for first-time home buyers, is also a key way of accumulating wealth and dealing with that inequality that we were just discussing. So,
well, certainly in our generation, that's what we thought. I will say for the millennials, I think they walked out of 2008 saying, it's not the tool that we thought it was.
Yeah, fair enough. But they're also getting burned on the other side because of the lack of affordability. So it's not a generation that's had it easy, given the two crises that hit it. I'm wondering, so there's a question from the audience about how you, kind of a softball, but a good segue. So how does your consulting background inform your role as a Fed official? I think we can already see from the way you think about the economy and talk about sort of real factors, but and the simplicity with which you communicate, the lack of jargon in your speech. But I wonder, in particular, how are you looking at? Chair Powell used a term that I like, which is we're going to recover, but to a new normal, or into a new economy, I believe he said. And I just wonder what kinds of sectoral changes are you seeing that might not be sort of macro relevant, but at least might change the way that we live our lives.
Yeah. Okay. So there's a lot there. So let me unpack it. So first of all, I do think diversity is really helpful in what we do. And each one of us as FOMC members needs to think about what do we uniquely bring to the table. And I do think, my business background, consulting background has the potential to be something unique. I think it's actually critically important, though, that you respect the profession you're in. I don't need to be some, random guy who shows up and, thinks he knows everything. And so I'm a voracious reader, and I've read, tens and thousands of pages to try to understand the profession that I've walked into and be respectful of it. And that's just like what I would do in consulting. I wouldn't go into a new industry and pretend I knew it. I would try to go into a new industry and try to learn it. So then now that you're in that industry, I really do work hard to stay in touch with what's happening on the ground with business people. And we've reshaped our outreach function to be much more active and on the ground in terms of trying to figure out what's going on. And certainly during COVID, it's paid massive dividends. I had interim board meetings, every couple of weeks, just to hear from our board members what was happening. When I'm not in blackout, I talk to 3, 4, 5 business people every day and community people about what they're seeing in their markets. Before this call, I talked to a guy who makes windows and installs windows to try to understand what trends he's seeing in the housing market. I'm on a constant thing. And part of it is that contact. But I think there's a potential maybe just to be able to interpret stuff. And we talked a little earlier about the forces that drive pricing and how business people think about pricing. I think I have a different view of that than, a textbook might have on it. So maybe I'm right, maybe I'm wrong, but I do hope to be differential. in how to do it. Coming out of COVID, I think I wrote a paper on this, but the market hasn't really spoken about what's going to happen after COVID. So there's a set of stuff that you and I both know. Telehealth has been validated. More and more people are going to go online to shop. You can, do takeout a lot easier. All of that kind of stuff is pretty obvious. But I think what isn't obvious is, what's going to take and what's not going to take tomorrow. The stuff that I think is going to be most fundamental, I do think that this current labor shortage we've got is not, has got some structural components. I've talked about the temporal components, but I think there's some structural components, demographics and other. And I do think you're seeing employers invest ever more in labor replacement. If you walk into a manufacturing plant today, it's very hard to find any manufacturing people, right? You can find some maintenance people, but it's very hard to actually find manufacturing people. And I think, I was in CVS the other day, and they're rolling out, whatever the scan technology for checkout. I think you're going to see that more and more and more. How many of us figured out mobile deposit, in our banks, as opposed to going to an ATM or going into a branch? So that seems like a sectoral thing that's clearly going to hit. I think on this whole notion of work from home or not work from home, I know there are employees who are dying to work from home. I know there are employers who really want to have their people in person. We'll see who wins that. And I'm not at all clear in my mind. I think it'll differ by business, by the way. I think there are businesses where the innovation and the collaboration really matter, and those who come back in person are going to win. I think there are, markets where making employees happy really matters, and those who go remote are really going to win. By the way, I keep telling my kids, if you're an employee who wants to work remotely, I hope you're willing to, compete against offshore people who will also work remotely, because that's the market you've just entered. And I think you're giving up. But again, I can say what I think, but the core is the market's going to vote on this thing. And it'll probably be 5 years before we really know. And I think a lot of these things are going to evolve in ways we don't expect.
Yeah. There's another question about the inclusiveness aspect of the new framework and how to define full employment more broadly. I just wonder what you hear from your community development contacts and from that aspect of your outreach function informs how you view that.
Yeah, so I get asked a lot of questions about the phrase broad-based and inclusive, and the way I interpret it is we're not going to be as preemptive as we used to be, right? Everyone in the SEP has a forecast on what maximum employment is. If you look at the range, I think it's somewhere between 3.5 and 4.5. The theory of the case was once you hit a number, you would start to raise rates. I think we've said now is something that says, wait a second, inflation also matters. And we're not so smart as to have a perfect metric, a perfect sense on what the number is. And most economists would say the number moves around during the cycle as well. And so, we're going to be a little more evidence-based on full employment, not just, caught in our analytics. I think that's what that means. That's different than saying, we're not going to do anything until we see, each of 13 groups having labor market performance equal to that of whatever. I think that's just a different way to think about it. So I think of it more as preemptivity, which I know is not a word.
That works.
On the community side, we're in constant contact with what's happening, in the labor market. I think the thing that's most interesting to me right now is the question of, is there a segment of people that used to think of leisure and hospitality as a secure, fast-growing career that provided hours, comp, and stability that they were comfortable with, who have, woken up coming out of COVID for whatever combination of reassessing life, understanding that there's actually volatility in the segment, being treated poorly by customers, and moved into other sectors. And, I'm curious about whether there's actually been a rotation of supply toward a certain set of sectors where they can do a good job and away from an industry. And I say industry, it's a number of industries, but and how permanent is that? How long lasting with that? And what are the implications of that for the economics of and the vibrancy of those sectors. That's something I'm starting to pick up on the ground. I'm just interested in how that plays out.
I mean, it is fascinating. I mean, the notion of having a shortage, I've heard people say in jest that it's not a labor shortage, it's a wage shortage. But as you pointed out, that might be the case in services, but in manufacturing, maybe not so much because the wages are already fairly high.
Well, one thing that influenced me, I was with a community college in Hickory, North Carolina. Hickory is a big manufacturing area, particularly furniture. And we were talking about their retraining and reskilling efforts and what they're doing to try to, connect all of these open jobs to people in a community where there are unemployed people, there are underemployed people. And the thing I took away from that is in 08, or maybe even the 10 years before that, when the furniture industry, collapsed and a lot of it went offshore, parents told their kids, don't go into furniture, right? Whatever you do, don't do what I did, don't go into furniture. And so despite the fact that you've got a very hot market today, you have very real structural barriers to meeting the supply needs of that market. And yes, you could raise wages and prices, but then you'd be out of the market. And so that doesn't work, either. And again, I don't know that it's going to happen in leisure and hospitality and in-person retail and those kind of things, but maybe we're seeing a shift too. That was a business that did nothing but grow for 30 or 40 years. Maybe what's happened in the last couple of years is, create a little bit of pall on that sector and maybe people move into other sectors.
Does that create the possibility that it'll take more than just a few months to sort out where the chips kind of land?
Yeah, well, this mismatch issue is pretty interesting. You can talk about truck drivers, and it's pretty obvious we need more truck drivers, and people don't want to go into truck driving. And for part of that is lifestyle, and probably part of that is if you think your job is going to be automated 5 years from now, why would you invest in it today? Then we've seen it in construction and manufacturing and, skilled trades. That's another place. You hear about it in tech. You hear about geographic mismatches. And so maybe now we're also going to have sectoral mismatches. On the other side, if anyone can work remotely, maybe you're going to free up some of these regional mismatches and you're going to be able to find people for jobs without having to move their geography. So there are puts and takes in the labor market, but I'll be interested in how that plays as well.
It's become a little cliche for Fed reporters to end on a climate question, but I'm gonna fulfill the cliche because, and I think that maybe in a few years the climate question will be the first question, if this heat wave outside is any signal. But I really I joke about it, but it's not a laughing matter really. It's a very serious one. But I wanted to ask you in the following way. I know your bank has done a lot of research on climate. It is a politically sensitive topic in the U.S. and I'm amazed at just how politically sensitive it is. The Fed gets flack on the left for having joined the fray too late, and on the right for even mentioning the term climate. But how do you assess risks that are so unpredictable, and how do you build them into how do you create a language and a measurement system for things that are so volatile and unpredictable?
Well, I do appreciate all the attention we get on this topic, but I'm from the school of, you have a narrow mandate, stay within your narrow mandate. To the extent climate is relevant to that narrow mandate, absolutely research it. There are a couple obvious places where it is relevant. Tuan Phan, who's a researcher in our team, has done a bunch of work on the impacts of rising heat potentially on economic potential. And I think that's a pretty interesting topic to dig into. And, I represent a district where heat is part of how we grew up. It's a pretty warm district. What about more heat? What would that do? And I think that's hurricanes matter in our district. More hurricanes, what would that do? I think those are legitimate things as you try to understand the economy and the future economy of your district to try to understand. We also oversee the banks. And so to the extent that you've got, banks that have disproportionate exposures in sectors that might be at higher risk, you want to understand that. And we already do that, for example, with coastal exposures and hurricane risk. If you're a South Carolina, North Carolina, Virginia bank, we would already look at that in our oversight. And so I that's where I go. I don't think what I've said is or should be controversial. I think it's a very good place to go. It's obvious, and I think it's obvious to everybody, that we can't solve all the world's problems, and so there are real issues in the U.S. and globally on the climate side that I hope and expect people who have the mandate to look at are going to be pushing on. For us, I think my view is focus on what you've been charged to do and try to do that very well.
Okay, well, we're exactly at the top of the hour, and I think we've covered a lot of ground. So I'll just thank you for joining us today, Tom, and thank our viewers for joining us from around the world.
Appreciate being with you. Thank you for the